right now on IMF Today, the state of the global economy. The World Economic Outlook and the Global Financial Stability Report are out.
The global economy remains on track for a gradual recovery from the pandemic and Russia's war on Ukraine. We have repeatedly warned this would not be an easy ride.
What we have seen is that central banks and deposit insurance companies do have the tools to address any turbulence in the banking sector.
Yeah, climate change presents a major threat to long-term growth and prosperity.
The sense of urgency has increased, and what's evident here in the discussion with the IMF is the willpower has increased, but so have the complexities.
We are making progress, but we need to be doing a whole lot more.
Good afternoon and welcome to IMF Today. I'm Amanda Walker and today is the big one, the much anticipated World Economic Outlook. Let's get straight to it. Here are the three main headlines. Now, persistent high inflation and financial sector stresses are impacting the outlook. Projected growth is 2.8% in 2023. It goes up a touch to 3% in 2024. In the medium term, global growth will remain at about 3% over the next 5 years. That's the lowest medium-term growth forecast since 1990. And about 90% of advanced economies are projected to see a decline in their growth rate this year. Now, IMF chief economist Pierre-Olivier Gorenchard delivered the news. He's here with me to talk about it now. So, Pierre-Olivier, how would you characterize these numbers from today?
Well, I would say that we have three forces that are playing on the outlook, really. And the first one is, of course, the fight against inflation. Central banks have been increasing interest rates, trying to cool off the economy, make sure that prices, inflation comes down back towards the target. That's number one. Number two, the reopening of China. It's already started late in 2022, but it's, we have now more evidence that it's underway. It's very robust. Chinese economy expected to grow at 5.2%. This, combined with other countries in the region, especially India, this is really one of the powerhouses, emerging Asia, for the global economy. Third, financial instability. We've had a pretty big scare in the last month, and we had already some tremors back in the fall. And looking forward, we can be concerned about how stable the financial system is, and that's likely to also weigh down on activity going forward.
So you talked a lot in the press conference this morning about the risks the world is facing. What lessons would you say we've learned in the last few months? And then, of course, before that, and still ongoing, one of those things, a war and a pandemic.
Well, of course, we have to put everything in perspective. And our global economy is still convalescing. We're still recovering from these powerful blows that we've had in the last 3 years, as you said, pandemic and a hot war on the European continent. And so there is something to be said about, yes, we can see growth going up, we can see inflation coming down. These are sort of good news, but it's slow and it's not going as fast as it should be, perhaps. And then on top of that, we have this inflation problem that is showing to be more persistent than expected. So how much more monetary tightening will we need? That's a big question going forward.
Now, fragmentation, this is something that has been talked about a fair amount this week. Certainly the managing director mentioned it when I spoke to her as a very costly thing. Can you just outline what it actually means and what it could cost?
Well, fragmentation, geoeconomic fragmentation, refers to the fact that, we've had growing tensions in geopolitical tensions in the world between different countries or groups of countries. And of course, the war is accelerating some of these tensions and making them even stronger. And looking ahead, we can be worried about a world that would become fragmented into distinct economic blocs that would not do much business with each other. Now, to be clear, this is not where we are. We are still very integrated, much more than we've ever been. But we already see signs, and we have a chapter in our World Economic Outlook on direct investment. We have signs that increasingly so, direct investment is driven not so much by geographical proximity, which used to be the case, but by geopolitical proximity. Are we friends together? Then we tend to invest together. If we're located nearby, but we're not friends, we're not necessarily investing a lot into each other's economies. And that is a concern going forward because that's a sign that this fragmentation could already be there. We do an exercise where we try to quantify the economic losses that would happen in a very extreme scenario where we would fragment completely with maybe a few countries left in the middle not taking sides, and the costs are very, very substantial, about 2% of world GDP. So this is sort of sounding the alarm that, this is not a path that we want to embark on. We want to make sure that we preserve an integrated economy, a diversified economy, a resilient economy, but not one that is balkanized in fragmented blocks that don't talk to each other.
Okay. Pierre-Olivier Gouranchat, I know you're an extremely busy man this week, so thank you very much for your time.
Thank you for having me.
Now, that World Economic Outlook goes hand in hand with the Global Financial Stability Report. And stability is on a lot of people's minds with the recent news about Silicon Valley Bank and Credit Suisse, which has made a lot of people nervous. I spoke with the head of the Monetary and Capital Markets Department, Tobias Adrian, and asked him what the biggest risks to global financial stability are right now.
Monetary policy has been tightening for about a year and a half. In some countries it started even earlier. So interest rates have been increased and financial conditions have been tightening. That has triggered stress on certain financial institutions. We saw a dramatic stress in the US in March when the Silicon Valley Bank failed and Signature Bank also failed. And that was really triggered by these unrealized losses on the security portfolios of the banks. So the combination of having losses on the asset side and then deposits that were withdrawn very quickly triggered stress. This is one illustration of what can happen when interest rates are increasing, but there are many other pockets of vulnerabilities that could be triggered going forward, in particular if interest rates have to rise further as inflation surprises to the upside.
So how is all this impacting ordinary people?
So ordinary people are severely impacted by inflation. So the first order goal of central banks is to get inflation back down to target. Inflation is costly for everybody. People have to pay more for fuel, for food, but for everything else as well, housing, and consumption goods. So that is the first order goal for central banks, get inflation back down. But of course, to get inflation back down, economic activity has to be reduced. And this is why interest rates are increasing. So rising interest rates have also hit households. For example, mortgage rates have increased tremendously. If you buy a new house, your mortgage is going to be much higher today than it was 2 years ago.
So in terms of finding solutions and way forwards, how important is consumer confidence in the banks, in the financial institutions?
Trust is the foundation of finance, right? So banking has always been about maturity transformation, and it was inherently fragile for many centuries. This is why central banks were created, the Bank of England, the Federal Reserve, the Riksbank. They were created to make sure that the banks were not subject to those runs that we have seen. So this system works largely. However, when interest rates are increasing sharply, often real activity slows down, there are oftentimes recessions, and oftentimes there's financial stress. The financial stress could be revaluations of equities, like in 2000 when the tech bubble burst. It could be outright financial crisis, like the 2008 crisis, or it could be more contained crisis, like the savings and loan crisis.
So spring meetings this week, obviously, getting heads together. What role can the IMF play in tackling all of this? What tools are available?
The IMF is really at the core of the global monetary system. So for the vast majority of our membership, the kind of programs that we make available to countries is essential and oftentimes existential. So some countries have precautionary programs so that they have some insurance against any adverse shocks going forward. Those precautionary programs have proven very, very useful during COVID and since. And more countries are asking for these precautionary programs. Secondly, there are the standard programs that are going hand in hand with getting the macroeconomic policy back on track towards a more stable growth prospect going forward. And then thirdly, there are the loans for lower income countries. Those are concessional, and they are really helping the poorest countries in the world. So the IMF is essential for the cohesion of the international monetary system.
Okay. Tobias Adrian, thank you so much for joining us on IMF Today.
Lovely, thank you so much.
Thanks. Just a few hours ago, the stage behind me was set for the first seminar of these spring meetings. The topic, climate finance and energy security. Now, the IMF estimates that $1 trillion a year is needed for renewable energy alone, but that it would pay dividends in terms of growth and jobs. During today's discussion, Tim Gould, the chief energy economist for the International Energy Agency, gave a clearer look at the big picture.
Now, since 2021, that's increased. In our view, we're probably around $1.3, $1.4 trillion each year, and that's not just going into renewable power, but into infrastructure, into access to a degree, although we need to be doing much more, into efficiency, into clean fuels, and all sorts of other technologies. And with new policies coming through by 2030, we think there'll probably be something like $2 trillion each year spent on clean energy transitions. But there are some caveats. And the main one is that if we are to get on track for a 1.5 degree stabilization, that 2 trillion needs to be closer to 4 trillion.
The recent experience of international cooperation that we have is vaccines, where we were told, be ready and it will come, and it didn't come. You know, we got the crumbs. So the question is, for countries that are prepared, like Egypt, like Rwanda, and others that are ready, that have done all the things that it had to do to contribute to the solution, where are the concessional financing windows that allow us to do what we want to do, not what we're told to do, what we want to do at scale and speed? And that's the main reason why we're here today, because we haven't received a clear answer to that.
Kampeta Sayenzoga, who we just heard from, is here with me now. Kampeta, you're with the Rwanda Development Bank, and that last point that you just made, how confident are you that you're going to get your answer this week?
Oh, I'm hopeful.
Hopeful, okay.
I think the theme of the spring meetings gives me that hope, and that's why we're here today. What was clear is that if we want to have a green transition, then the cost of capital has to be addressed. And wealthier countries have a way to address them through their own budgets, and less wealthy countries like mine have much less space to do that. So I think it's very telling that we're having this discussion in the IMF headquarters, because this is an institution with whom we discuss our fiscal space, our debt space, and our macroeconomic policies. So the key question is, can we do the green transition and remain stable macroeconomically?
Yeah, obviously a crucial topic at the moment. And just to pick up on some of what you mentioned in today's seminar, you talked about how for some countries it's a question of substitution, but for countries like yours it's a question of access. Can you just elaborate on that for me?
So I was giving the example of access to energy, which in many countries of the North, the discussion is, can we substitute fossil fuel for more renewable sources of energy? In my country, when we started 10 years ago, less than 10% of the population had access to electricity to start with. So we're talking about leapfrogging. We're not talking about substitution. Is how do we get universal access to electricity for the population at a cost that is affordable and in the way that is accessible for all? So for us, it's an issue of matching development with green transition, and we can't choose either. We have to do both. We don't have a choice. So it's a slightly different discussion from the substitution impact, because in the substitution, if you don't do it, you still have energy. You know, the lights are still on in the North. In my country, the lights are not on. So we need to find a way to ensure that the primary objective, which is a development objective, is achieved, which is universal access to electricity. But the costs at the moment is a key source of discussion.
Obviously, you're here in Washington, D.C. now, but the IMF came to you earlier this year, and we might be able to see some of that footage now. The managing director, Kristalina Georgieva, visited Kigali earlier this year. You were seated next to her. I think we can see that now at a roundtable breakfast in Kigali in January. And during that same trip, the managing director took part in a green entrepreneur event to promote sustainable businesses. How important, Kampeta, is the that kind of level of support, that visibility on the ground in Rwanda to what you're trying to achieve?
It is crucial. For us, it's very clear. If we want to go green, the private sector of Rwanda has to transform. It has to become green. And seeing the managing director of the IMF coming herself on the ground to see what the young entrepreneurs are doing, what kind of policy commitments the government is making, is basically merging the two debates, the debate around macroeconomic stability and the debate around the green transition. And for us, it's of great comfort to see that the IMF itself see the two debates not as separate discussion, but as one and the same discussion. So for countries that were already committed to being green, Rwanda was one of the first, it's very encouraging to see that now we are discussing stability in the context of climate change. And that helps us to think through some of the issues that we've discussed earlier in terms of how do we use our fiscal space, how do we use our debt space for climate change, as opposed to looking at climate as a standalone discussion and macroeconomic stability as another discussion. And our hope really is that by merging the two conversations, we'll also be able to make a clear call for access to additional financing. And I'm raising the issue of additional financing because in the context of multiple crises today, my country has suffered from high inflation. We now have 20% inflation in Rwanda. And the question is, can we reach our macroeconomic objectives such as inflation and reach our green objectives set in the NDC in a context of limited resources and in a context where doing the right thing is more and more expensive with hiked interest rates.
So lots of work ahead, but it seems like some progress, and certainly you'll be hoping for more of that this week, I'm sure. Kampeta Sayinzoga from the Rwanda Development Bank, thank you so much for joining us. Good luck with the rest of the week.
Thank you.
Now, that was the first of 7 seminars this week. Tomorrow, we're focused on debt, with one seminar on how to tackle soaring public debt and a second on spending well and accountability. Thursday's first seminar is discussing young entrepreneurs and digital transformation in the Middle East and North Africa. That's followed by the debate on the global economy. Then on Friday, a look at digital public infrastructure, stacking up the benefits. The seminar series wraps up with how should central banks battle high inflation. Now, the World Economic Outlook and Global Financial Stability Report are, of course, announced here in DC. The ripple effects are felt across the world. Gillian Tett is an author and Financial Times US editor-at-large. Thank you so much for joining us. I want to talk about your inspired conversation yesterday, which was so interesting. First of all, though, today's figures. What do you make of them?
Well, there's both good things and bad things. There's a glass half full, glass half empty story. I mean, what is clear is that the global economy is going to be facing some very difficult headwinds for a long time. And there are really big downside risks, that much is clear. And even though the IMF said, trying to be optimistic, that it's possible to cut public sector debt through growth and inflation, we've seen that before in history, the reality is that with interest rates this high, it's going to be extremely hard. So there are really nasty questions about redistribution facing most economies at the moment. And on top of all that, of course, as we have interest rates go up, as was laid out so clearly in the Financial Stability Report, there is growing risk of all kinds of chain reactions, which are going to be quite potentially nasty and unexpected, not just in the banking sector, as we've seen, but the non-banking sector. So big picture is there are lots of challenges ahead, but at least the IMF is still forecasting growth. That's the good news.
Yeah. We'll always take a little bit of optimism. There isn't much around at the moment, and we have had some nerves jangling lately. You wrote a piece about March Madness. What's happening with banks has made a lot of people very nervous. Do you think that madness has ended, or should we remain on the alert?
Well, I'm very cautious of saying that the madness has ended because I covered the 2007 and 2008 financial crises, and also back in Japan, the 1997 and 98 crises there as well in the Japanese banking system. And the reason I'm saying 2 years each time was that the crisis started often with one institution going down or one shock in 1997 and 2007. And it took a whole year and a bit before we actually saw, if you like, the pinnacle of the crisis actually explode. So yes, we've seen some small banks, smallish banks in America fold. We've seen Credit Suisse be merged. Those have been dramatic effects. It does seem, as the IMF said in its own report, that the immediate shock of that has been contained by some quite deft moves by policymakers, with the extension of the deposit insurance in America, the fact that the Fed's been using its window, the fact that Credit Suisse was merged with UBS. All of that has helped to calm things down. So that's the good news. So as things stand at the moment, we're not really looking at a crisis per se, but as the IMF report also pointed out very correctly, there's a real issue about the non-banks. We just don't know exactly what's happening inside the private capital world because guess what? They're private. They don't have to mark down their assets in a timely fashion. And we've never had a financial expansion, or bubble, as I call it, of this scale before, where private capital has played such a crucial role. And we're only going to find out in the next year or two what exactly has been happening in private capital and just how much pain there is still to come there. And that's concerning. And on top of that, of course, you have the usual commercial real estate issues, which always crop up whenever you have a bubble deflating. And we've also got questions around the insurance sector, which again were highlighted in today's report.
So you're here with many hats on, aren't you? Journalist, moderator, speaker yesterday at IMF Inspired, and talking around your book, Anthrovision, and bringing in this idea that economists can learn a lot, or anthropology can complement what economists are trying to do. Can you give me an example of that kind of thing? Because it was really fascinating talk about just looking a bit beyond the figures and how beneficial that can be.
When I was an anthropologist back in the late 1980s, as my daughters, teenage daughters often tell me, I'm officially very old and middle-aged.
Teenagers will do that.
The IMF was seen very much as a bastion of neoliberal economic thought and a vision of economics which was, you know, pretty technocratic, and it really focused just on the numbers. And when people at the IMF joked about it, IMF standing for it's mostly fiscal, that reflected a mindset which was really all about balance sheets and fairly mechanical models of how IMF advice actually worked. Now, what I find truly fascinating is in the last few years, the IMF has really changed the way it looks at the world, starting after the great financial crisis with Christine Lagarde, and now, of course, with Kristalina Georgieva, really trying to move into areas like climate change, into gender rights, into medical risks, all these kind of things which used to be ignored. Now, the reason that matters is because in the last decade, all of the stuff that we used to consider as footnotes to company accounts or things that were external to the models that economists used, like environmental issues, like the question of, say, social tensions or medical risks, all of those issues have become absolutely center stage. And these are the kind of things that anthropologists have long looked at. They tend to have this vision of what they called embeddedness of economics. To cite Carl Polanyi, the economic historian, it's a way of trying to recognize that economies are always fundamentally social and political constructs, even with all the numbers, and you need to be aware of the wider context at all times. So essentially what I was arguing for was context-based economics, lateral vision, not tunnel vision. And the world is moving that way, particularly in relation to climate change. But I think actually there's still a lot further than it can go.
Everything's evolving. Gillian Tett, thank you so much for joining us.
Thank you for having me on the show.
Now, today also saw the start of our Governor Talk series. And look at this, it was a full house in Cedar Hall for the first one. It featured the Governor of the Central Bank of the Philippines and echoed a topic Pierre-Olivier touched on in this morning's World Economic Outlook: sticky inflation, specifically what it means for monetary policy in emerging Asia. So many contributors at these meetings, and not just ministers and central bankers. There are also dozens of civil society organisations who are represented here, working to have their voices heard as well. Patricia Miranda is the Global Advocacy Director at Latindad, which is active in 12 Latin American countries and works for social, economic and environmental reform. And she joins me now. So how important is it for an organisation like yours to be present at this kind of gathering?
Well, thank you. It is important because we are here to raise our views, our concerns, but also our proposals in terms of global economic policies that are urgently needed now, especially if we talk about the current context of multiple crises that is severely hitting southern countries, and in particular to the people that is more exposed to vulnerabilities. And
tell me what those are. What are the main challenges people are facing in Latin America?
well, it's economic vulnerabilities, social, but also climate vulnerabilities. And we are glad that the climate is on the agenda now in several arenas and spaces. But we are here to raise these voices. We work with grassroots, and we know what are the impacts. And we are facing an unequal recovery in the worst crisis that the world has in more than 100 years.
Okay, so it's a packed agenda. We know how busy it is in these buildings, lots of people with different goals, different priorities. What are your goals and how do you hope to achieve them this week?
Well, the opportunity for us is to have the space to discuss and have an exchange with global decision makers, with the IMF, which are key to implement and establish global economic policies that are at the service of people. A new financial architecture is needed. Our assessment is that the current system and the current tools are not enough and are not really delivering what people need, what the world needs. And I'm talking about, for instance, we need debt service cancellation. Countries are prioritizing the payment of debt service, but it is at the expenses of people. This prioritization is over investment in education, investment in health, in social protection, and in climate adaptation. But in addition, our countries need to have a debt restructuring mechanism which is transparent, independent, binding, and this is urgent. There are several projections, there are several information and data, and we know that more than 50 countries are in debt, in severe debt problems. So in the next months or in the next 2 years, there will be more countries getting into debt default, and we need the necessary and enough tools to address these problems. But in addition, it's not only about debt. It's that countries also need access to new concessional financing. And the allocation of a special drawing rights has been a very important mechanism 2 years ago to deliver liquidity for middle-income countries that have didn't have any access to other global economic policy after the pandemic. And this is concessional finance that has been used not only to strengthen the international reserves, but also to use it with fiscal purposes to tackle health systems, to invest in social protection, and hopefully a rechanneling of special drawing rights would happen, not with more debt, not with more debt burden for countries, but to contribute for climate adaptation.
Okay, Patricia, Miranda, so much to talk about. Unfortunately, we are going to have to leave it there. Good luck with the rest of the week.
Thank you.
So, you think today was busy? Well, just wait until you see tomorrow's schedule. It starts at 8 a.m. with the Fiscal Monitor report. Then at 10:30, those new economy forum sessions kick off with one focused on the use of artificial intelligence. At noon here in the atrium, we're talking about how to tackle soaring public debt. Then at 2, we'll follow up with a discussion on spending well and accountability. We have 2 governor talks tomorrow, one with the DRC, the other with the UK, as well as 2 capacity development talks. And we round out the day with a high-level talk on building capacity to manage public debt. This is all in addition to the various ministerial meetings and roundtables throughout the week. For now, thanks for joining us on IMF Today. If you didn't see it all, don't forget you can watch the show from the top on catchup@imf.org. I'm Amanda Walker. Let's do it all again tomorrow.